Welcome to the Professional Investors Podcast. Today we look at the first budget for 14 years from a Labour government, with a particular focus on its impact on business relief and AIM-listed shares. We'll be joined by Chris Boxall and Stephen Drabwell, portfolio managers at Fundamental Asset Management, and I'll be asking them questions sent to me this week by our audience. Before speaking to Chris and Stephen, from getting the feedback from so many of you since the budget, I know there are a lot of questions regarding how useful business relief may be in the future. So as well as hearing what Chris and Stephen have to say on the subject, stay listening to the end for some information I thought you might find useful from the Office of Budget Responsibility's Economic and Fiscal Outlook, which was released on the day of the budget itself. It gives the OBR's outlook on the tax benefit after the changes have taken place. Welcome, Stephen and Chris. We're going to be discussing the changes to AIM in light of last week's budget. We've had questions come in around the consequences, and we'll go through those. But first of all, Stephen, I don't know if you want to run through some of the headline changes in terms of AIM.
Yes, I can certainly do that. Really, the major change regarding AIM is that the relief that you get for holding AIM shares for IHT purposes has been cut in half. So you're only going to get 50% relief now. So effectively, you're going to pay a 20% inheritance tax on assets held in AIM that you've held for longer than 2 years and that are in qualifying companies. The other significant change is that on business relief in general, that they've brought in a threshold on the first £1 million which will still be get 100% relief. But thereafter, you'll get the 50%, only 50% relief, so you'll be paying 20% that on other business assets. However, as far as we're aware at the moment, and the devil will be in the detail when the Finance Act is updated, that £1 million does not apply. That £1 million threshold does not apply to AIM shares. So the first pound held in AIM for longer than 2 years will be subject to just the 50% relief.
Thank you very much indeed. I'll go through these questions that we've received. Some of it may be going over some of the ground you've just covered there, but I think because there's a few question marks over some of it in terms of our audience's mind, I think it might be worthwhile going over some of these bits
again. It might be worth emphasizing as well that these changes aren't immediate. They are from April 26, so nothing is happening immediately. So we have a cooling off period, so to speak.
Thank you. And indeed, I understand there's been representations already from a number of AIM companies to 10 Downing Street, I saw yesterday, with regards to perhaps trying to make some further changes if possible. They may not happen. We have to assume, obviously, they won't, but there seems to be some lobbying going on about it. Our first question comes in. This is for Stephen, is there £1 million limit on the 50% reduction of the new IHT charge on AIM shares?
As I previously mentioned, there is a £1 million threshold on business assets, but as far as we're aware, that will not apply to AIM shares or other unlisted shares. It only will apply to family businesses, private businesses. And not to AIM, but as I say, the devil will be in the detail, and I'm not quite sure that the Treasury and the government have clearly thought through everything in detail.
Thank you, Chris. One for you. Have the replacement provisions for the 3-year permissible dwell period been changed by the budget? Have they been changed by the
Yes, it's probably just worth recapping on that point. The replacement provisions cover the replacement of business relief qualifying shares, which means that you can sell a share, and as long as you reinvest in another qualifying share within a 3-year period, the initial period of ownership will go towards meeting the 2-year minimum holding period. This is clearly quite attractive. It's always been quite attractive in the replacement relief rules. And as far as we're aware, again, as Stephen has alluded to, we might see being the devil's in the detail, but there have been no changes to the replacement relief rules. But we haven't seen the details, and that sort of item and element it would be in the detail. But as far as we're aware, no changes up to now.
Thank you. So the next question Stephen, this one's for you. Given the proposed reduction in the inheritance tax relief available through AIM holdings from April 2026, will existing AIM fund holders lose their existing qualification by moving to, in inverted commas, pure business relief plans and therefore see the 2-year clock reset?
Well, again, there's been no detail issued on this, but I would say it's unlikely. I think it's still under the business relief rules. So as long as you're reinvesting in qualifying business relief assets, then the clock shouldn't reset. Obviously, there are other rules to follow in terms of that you're using the same sources of money, but I can't see why there would be they would prevent you from doing that.
Chris, a question for you. Does the new 20% inheritance tax start at the beginning of the 25-26 tax year? Is there a process to find out which companies in an AIM holding will qualify for AIM relief and thereby, the 20% inheritance tax? Perhaps there's two questions, one which we've sort of covered already, and that's to do with does it start at the beginning of the 25-26 tax year?
Yeah, I mean, as far as we're aware, it's starting from April 26, so it's not at the beginning of the tax year. It seems the implication is that it's effectively at the end of that tax year, beginning at the start of the following tax year. Clearly, the date for inheritance tax purposes is specific. So if somebody dies from the 6th of April 2026 in that year, that'll be the relevant. With regard to the process of finding out which companies and AIM qualify, the HMRC does not produce a definitive list. So the qualifying rules, as far as we're aware, will remain as previously. There has been no definitive lists. Companies change their business strategies and their business structures, which could impact their qualifying status. Our associated Investors Champion AIM search tool gives guidance on which AIM companies qualify and which don't. So people can visit that. Clients of Fundamental have access to that as well. That's the AIM search tool. There's another question, the same questioner asking about capital gains rules. Well, AIM companies have never benefited from specific capital gains tax benefits, so that remains. There is no stamp duty payable on AIM purchases. Well, that's a difference to the main UK stock market. That remains in place. Again, there's no particular benefit of tax on dividends. However, the clear beneficiary is that AIM shares can be held in ISAs, which would obviously mitigate the CGT and indeed the income tax. Again, that remains in place. So we're as we were in that respect.
Thank you. Our next question that we've received is as follows. I'd be interested to hear your comments about holding an AIM portfolio within a defined benefit pension scheme, aka SIPP. Clearly, we have to wait for the final outcome from the pension consultation. In the meantime, I'm assuming pension savings under defined contribution schemes will become subject to inheritance tax from April 2027. What's not so clear is the income tax hit on beneficiaries. So this is saying, it goes on to say, from my perspective, 50% relief on any pension savings at the time of death is preferable to 0% relief.
Yeah, I mean, yeah, I would agree with that. Any relief is better than no relief, absolutely. So we would concur with that. I think SIPs and pensions are going to be quite complex when it comes down to this and inheritance tax and investing in business relief qualifying assets. And again, I don't think the Treasury have probably thought this through in any detail yet. They've effectively slung a headline out there, and then they'll deal with the aftermath as and when. And that's why they've given themselves till 2027 to try and to sort it out. But as from what we've read, yes, their income tax will be hit. Beneficiaries will get hit with income tax as well as inheritance tax. But we await the detail. But as I say, I think holding AIM shares in SIPs is going to have to be a lot more work on it. before it comes into effect.
Thank you. The next one for Chris. Is investment in forestry damaged in the same way as in AIM?
It's a tricky one for us. I'd rather not comment in depth about forestry because it's really not our bag, but there is a reference to AIM. And as far as we've read and looking at some reports on forestry related websites, yes, the business relief changes will also hit commercial forestry. That's commercial forestry. And that could be quite an impact because I know a lot of people have been attracted to using these forestry schemes to mitigate inheritance tax. But it looks like commercial forestry will be bandied with the rest of the business relief schemes, so that there will be a reduction in relief if for those investing in that space.
Thanks, Chris. Another one for you. It sort of moves more onto some scenario-based questions. Um, will existing AIM inheritance tax portfolios be affected retrospectively subject to new inheritance tax rules?
Well, to all intents and purposes, yes, really. Not currently, but post April 26, even if you've held AIM shares for a long time, an AIM portfolio, post April 26, you're going to not benefit from 100% relief. You're effectively only getting 50% IHT relief. So yes, in that respect, it is conceivably retrospective, um, which is you know somewhat infuriating to say the least for those that have carefully been investing with a long-term investment perspective, and they're now going to be hit. And investing all is about the long term, so that's clearly not great at all.
Thank you. Next question, Chris. Switching clients from traditional stocks and shares ISAs to AIM ISAs promise the holy grail of removing all three taxes, income tax, capital gains tax, and inheritance tax. However, this was at the price of many clients jumping, considerably so in many elderly clients' situation, up the risk profile. Given that the inheritance tax strategy is now a fail, or at least a partial one, are some advisors facing the prospect of ambulance chasers coming after them for unsuitable advice, particularly if some clients now decide to divest entirely from AIM ISAs and pursue another strategy entirely for 100% inheritance tax effectiveness? Maybe 7 years under potential exempt transfer, whether by gifting direct or to trusts or taking the BPR route.
Yeah, it's a good question, and there are so many interesting points in this. Let's deal firstly with the term BPR. The new government's knowledge or lack of this space is probably reflected in the fact that BPR itself was changed to BR, I mean business relief, rather than business property relief, some years ago. The budget now has bizarrely started referring it as BPR again, business property relief. So it's reinstated an old term. Perhaps they hadn't really read into it enough to realize that the term had in fact been changed. So that's not a great reflection of their knowledge of the space, full stop. However, dealing more specifically with the question, yes, the AIM ISAs gave a terrific boost to AIM, and you saw a lot of people transferring into AIM ISAs, normal ISAs. I mean, it's just an ISA. It was the fact that AIM shares were allowed to be held in an ISA format, and that gave a good boost to AIM several years ago. And yes, it was certainly almost the holy grail, because you did shelter in income tax, capital gains tax, and IHT. And that remains in place as far as we know. So it's clearly very attractive for people with ISAs to still transfer to AIM shares. However, there has to be some confidence in the AIM market itself, and clearly there has been a lack of confidence over recent years. So the ISA relief has somewhat been sort of deflated by the lack of performance, and clearly people would have been better off holding an S&P 500 tracker fund. With regard to the comment around ambulance chases, well, advisors can only really advise based on current tax legislation or perceived tax legislation. I mean, who knows when if taxes change? Clearly they have to. Advice needs to change, and in good faith, they gave this advice to clients as it was a no-brainer really, an AIM ISA and potential mitigation of inheritance tax. So yeah, I think it's probably a bit harsh to reference them as, reference there as ambulance chasers coming after them for unsuitable advice, because the advice was very suitable at the time. So we do have sympathy.
Thank you. Stephen, next question's for you. Will AIM shares be subject to capital tax, then inheritance tax when an estate is donated to beneficiaries?
Yeah, capital gains tax. Obviously, when somebody dies, their capital gain dies with them. And there was a lot of talk before the budget that might be changed. That when passing them on to a beneficiary, the gain would get passed on. But there was no mention of it in the budget whatsoever. That's not to say there might not be in the next one. I suspect there was quite a few things like that they've held back for when they might need to raise taxes further. So, but as it stands at the moment, they are not subject to capital gains tax. The estate when the estate's being transferred, so the capital gain will die with the owner.
Thank you. Okay, for the next one, we've had quite a specific scenario painted, which I won't go through here because I don't think it's relevant to our listeners, and we also obviously can't give financial advice and tax advice to clients specifically. They need to seek that out separately. But it's with regards to gifting, and in this scenario, they've got multiple children and grandchildren, and they're asking if they can give 10 lots of £250 to three spouses each year. And I think that there's been a sort of misunderstanding of the gifting rules there. So I don't know whether, Chris, you can perhaps comment on that.
Yeah, I mean, with the gifting rules generally, I think it's misunderstood that this £3,000 a year is a total in aggregate. So you can't give £3,000 to each individual. I mean that doesn't fly, unfortunately. So it's £3,000 in total, and then there's a lot of focus. And HMRC, I think, gives a lot of focus, particularly in IHT returns, of regular gifts out of income. And I think that's always been something that people have drawn attention to. So making people can make regular gifts out of excess income. And so that's conceivably unrestricted. But it also has to be carefully monitored and documented and be consistent. So if people want to go down that route, yeah, as you've implied, they need to take a good advice, and it's best to get good advice early to be absolutely clear on all these gifting rules, because they can blow up in your face on the day of reckoning, as we have discovered, or some of our late clients have, or estates have discovered on the IHT return. So yeah, be careful of that, and we would, yeah, please go and get some good advice on that, how you should go about that process.
Thank you. The next question is I suppose this next set is looking towards the future of AIM. With AIM already under a serious credibility gap made worse by last week's announcement, where do you believe future interest, short and long term, will come from, if at all?
Yeah, it's a good point. AIM's been under a cloud. The change in IHT rules, or the potential changes, which have been now come about through the budget, have clearly been a downer, pulled back the market. There have been a lot of redemptions, lack of interest, and it has been a problem. It's emphasized as well the IHT influence in AIM. I mean, and it's important to focus, you need a viable liquid market. And, there's been plenty of selling and plenty of doubt. A lot of that's been driven by the potential IHT changes. So yes, it's not good. In terms of the credibility gap, actually, when all this has been going on, AIM's got some really good companies, and some of the share price movements that we've alluded to before have been absolutely ridiculous. I mean, you've got good companies seeing their shares sell off for no reason whatsoever, simply because of an IHT rule change. That's not to say they're bad companies. These are incredibly good businesses, the profitable, cash generative, paying out increasingly large dividends. So in terms of credibility, they're probably more, AIM is more credible than it has been. Um, so yeah, hopefully there will be strong interest. We've also had a lot of takeovers. The risk here now is that if shares remain weak, you're going to have a lot of cheapskate takeovers with relatively small premiums of AIM companies well before they've been able to deliver to their full potential. So yeah, if institutions mainly can support them and retail investors can continue to support them, there'll be a good future. It's worth hanging on as well for the pension rule changes, because the Mansion House Compact, which a number of large institutional pension fund managers have signed up to, has committed to quite large sums moving into unlisted shares, and unlisted in this case includes AIM. And there appears, the new government, there appears to be a greater sense of urgency to bring this forward prior to 2030. So this would see a wave of new money coming into AIM shares to replace potential losses through the IHT rule changes. Clearly, that's not immediate, but yeah, if the UK's largest defined contribution pension schemes are obliged to invest quite large sums into unlisted securities, AIM will be a winner from it. But yeah, it's not immediate, and it's the immediate that many people are probably going to be more worried about.
Thank you. Next question is for Stephen. Does it still make sense to still hold AIM shares, bearing in mind that you will only save 20% inheritance tax, while the AIM market over the last couple of years has been much lesser than the FTSE 100, and also taking the higher risks? So I think it's about the performance of AIM versus the FTSE 100 main market.
Yeah, I think if you look at AIM as a snapshot over the last 2 or 3 years against the main market, obviously it is significantly underperformed, and there's been, lots of talk of what's the point of AIM anymore type thing. But I mean, but in the years preceding that, it significantly outperformed the main market when it was going nowhere. So obviously it's very cyclical. Smaller companies generally, are a good place to invest in, and there have been some cracking stories on AIM. So let's not lose sight of that. The likes of Jet2 and Fevertree and others that we've moved on now for financial markets. So there's been lots of good companies. So I think to say that to compare it against the FTSE over the last couple of years is not entirely fair. However, in saying that, obviously the tax break has been cut, so it has made it less attractive. We can't hide that fact. And I think the government needs to do more to attract investment into smaller companies and patient capital. And at the end of the day, 20% relief is better than 40%. 20% in inheritance tax is better than 40%. However, and if you've got a lot, relatively long-term outlook, I'm sure a lot of these companies on AIM, there's some good companies on there, so you should do quite well as well. So I think it's you've got to look at the bigger picture and the sort of longer-term outlook, and hope that there is going to be more incentive going forward, that the government stands by its motto that it's been putting out, that it's the party of growth, that it does more to attract investment into smaller companies, because that's where the economy's growth is going to come from.
Thank you. So a follow-up question for you, Stephen. Will the changes encourage some or many of the companies currently listing on AIM to jump across to the FTSE All Share?
Well, there clearly is a risk, given that the tax break has been halved, and companies might start to think, well, am I better off being on the main market, where I'm going to be attracted to index trackers, etc. That my share price could get a boost. But I think in some situations, I think we probably will see that in some companies. I think we will see some of the larger companies may decide it's time to move to the main market. But there are also quite a few larger companies that have got family ownership, quite a strong family ownership inside. So by moving to the main market, they're going to be paying 40% inheritance tax on that, rather than 20% if they remain where they are. So they'll have that decision to make. And I think obviously the other thing is, nothing changes till April 26. So I suspect a few companies are going to mull over it for a little while before they jump. So.
Thank you. Chris, question for you. With the new legislation, do you think the AIM market will further deteriorate?
Not in the short term. The AIM market, I've never seen such a positive move following a budget. I mean, it was up now on 5% post the budget news. I mean, we've never seen that from AIM on a reaction to a budget. So clearly, the opposite has happened in the short term. So yeah, hopefully we're through the worst, and there should be some underlying support, and there has been a bit more strength, and hopefully share prices will now start to react more to real news and trading rather than a rumor of tax changes, which will be a nice change.
Next question. Should the boards of AIM companies be required under corporate governance code to give a view whether or not their company is eligible for inheritance tax relief?
I would say, has anybody looked at the boards of AIM companies, the depths of them? I don't think a lot of them have the skill set or would not want to take on the risk to do it. I mean, this corporate governance code versus tax risk. So I think that's always been a tough one, because tax rules change all the time, and it's really not the job probably of the company specifically to determine whether it qualifies or not. That's HMRC's, but yeah, that's really not one that for us probably.
Thank you. Stephen, next question we've had in. The budget would seem to have removed half the inheritance tax benefits of investments in AIM, which purely from the inheritance tax point of view makes less attractive as a home for investment. Are you able to estimate the proportion of total AIM investments which have been made to benefit from the inheritance tax exemption as was, and do you now expect demand for such investments to drop following the budget? Would this be sufficient? Would this be a sufficient drop in demand to reduce current valuations going forward? What are the advantages of investing in AIM for private individuals with half or possibly in due course none of the inheritance tax benefits?
Regard to the amount of money that's invested in AIM for IHT, it's difficult to put an exact number on it. I think in IHT products, I think it's estimated there's about 6.5 to 7 billion invested. But then you have, in addition to that, a lot of DIY investors who are doing it for themselves, and then obviously you have family ownership. So it's really difficult. But I would suggest something in the region of 25% of the 75 to 80 billion market cap is probably invested for IHT purposes. Obviously, which is quite a significant amount. And would this lead to a drop in valuations now? Well, we've already seen a significant drop in valuations over the last few months, to be perfectly honest, or over the last 2 or 3 years. But and then leading up to, with all the budget speculation, we saw a big drop off of the gains. So and then since the budget, we've seen a rally. So it's difficult to say that we're going to see a further decline in valuations. I mean, valuations look pretty cheap anyway, and these are still pretty decent cash producing, dividend paying companies. So I would be surprised to see a significant drop, especially until April 26, because nothing changes until then. So I think I can't see a massive sell-off at this point, and there's no evidence of it at the moment. So, and what are the advantages of investing in AIM for private individuals? Well, I think it's a good point that we've covered. Obviously, the attraction has been cut in half, and more needs to be done to invest in smaller companies, not just AIM, but smaller companies in general, and private equity funding, etc. So there needs to be more and more incentives put down by the government. As I say, the government's called itself the government of growth. So we'd like to see that they might have some plans up their sleeves. But I think we shouldn't lose sight of there are some pretty decent companies on AIM, and they should still be attractive for investment purposes, despite any tax advantages that you get.
Thank you. Chris, the next question. What practical steps can all parties involved with AIM, e.g., the companies themselves, the London Stock Exchange, and the fund management industry generally, take to stimulate and grow the market? If this were to happen, investors would put less emphasis on the tax benefits and more on the investment fundamentals, which would make for a healthier and more sustainable market.
Yeah, it's a good question. I think hopefully what the companies themselves have realised, which many of them haven't, or many of them should have realised by now over recent months, given the weakness in their shares, is how important IHT related money is to AIM and also retail investors. Because a lot of the selling has been driven by retail investors. Well, so the companies themselves could do a lot better job of promoting their attractions to the retail investment community. And a lot of them are really sort of dismissive of retail investors. And well, you're paying the price now, aren't you? Because it's evident that the retail community has a lot more strength in this space, or share price strength, than probably many have realized. The LSE as well has been absolutely appalling. I mean, they just don't do anything. In my opinion, they could do well, not anything that attractive anyway, and they could do a lot more to help promote the interest in smaller growth companies in a bigger way to appeal to the wider investment community. I think the fund management industry have been doing their best. I mean, there are a lot of small cap managers that do their best to promote their holdings and show, greater interest in their investment holdings. So I think they've been doing the best they can. Bear in mind they're probably more restrictive as to what they can and can't say. But yeah, the companies and the London Stock Exchange could certainly, I think, do a better job to help promote. If they really want to promote growth companies, really, get stuck in with some more, with some jazzier activities to help these businesses.
Thank you. Moving on to the next section of questions. It seems to me that it is very unfair for half of the relief to be lost on AIM shares in April 2026. This is effectively a retrospective tax because there is nothing that can be done realistically to avoid the tax, and the money was invested based on the expectation of full business relief. It should be brought in for the new investments, not the old ones. I hope this does not accelerate the demise of some elderly people. Are representations being made to try to persuade government to bring this on for new purchases, as would seem much fairer?
I think this is a very good point. I mean, generally, tax changes that are not retrospective, but clearly this one is. Again, as I've alluded to in previous answers, I don't think it has been properly thought through. The implications of what they're doing, and I don't think they've gone into much detail in this. I think the problem with it is it would be very difficult to base it on when the date of investment rather than the date of death, because the problem comes if a company moves to the main market, for example, and you buy something else and that's after April 26, effectively then that's back in your estate and there's nothing you can do. I mean, do they base it on replacement relief? Then they're going down a huge administrative hole, I think, in terms of you're trying to administer that. So I think it is very, very difficult to do it based on transaction date rather than date of death. But as I say, I don't think they've thought it through. So, I mean, the easiest way to have done it would be to allow these sort of things to be held in a product, like a wrapper. So you bought that wrapper on the given day. So as long as you were in that product before April 26th, then that can't be retrospectively touched. But because you've got to hold the shares directly and you can't hold them through a fund vehicle or a collective vehicle, it makes it very, very difficult to administer. Are representations being made to government to persuade them to try and change their mind? I think there will be. Obviously, everybody's going after them on the agricultural relief at the moment, so that seems to be the one where they're getting it in the neck at the moment. Whether that can then move on to business relief, I mean, obviously we like to think that that there will be channels and where we can make representations and to get some of these rules changed, because I think there's other unfair issues. The fact that the £1 million threshold applies to other business IHT products, for example, private company things, but not to AIM, is again unfair on AIM shareholders. Why should one benefit from a threshold and another one doesn't? Right? So I think there are lots of problems with this that haven't been thought through that need to be addressed before April 2026. The good thing is we have got a bit of time to do so.
Next question, Chris, this one's for you. Are you thinking of providing other investment products like EIS or VCTs, which I understand will still qualify for full inheritance tax exemption?
Firstly, VCTs don't qualify for inheritance tax exemption. One benefits from an income tax and a capital gains tax exemption, but they don't benefit from an inheritance tax. VCTs are listed on the main market of the London Stock Exchange, so they're main market listed investment companies in themselves, so they don't benefit from the IHT reliefs. EIS. Obviously, if the EIS related company is also listed, well, it's not going to benefit. However, generally speaking, EIS issues have the attraction of immediate sort of tax relief in forms of income and CGT deferral relief. They come with a load more risk and plenty of risk, and to the extent that if you invest in 10, you might be lucky to get 2 that make you a significant return, and a good number of that 10 are likely to, fail entirely. So that will people want to accept that considerably heightened risk for total loss of capital? And a lot of the more elderly clients that we deal with, quite frankly, an EIS qualifying investment is not suitable because they haven't got large amounts of income or CGT that is worth risking in the short term at least. I mean, there are exceptions, and I'm generalizing, but yeah, conceivably, I don't believe that EIS is really a viable alternative to many from the perspective of IHT relief.
Simply, where do we longish term investors in AIM go to restore a full IHT relief? Are enterprise zone type investments an option to consider? Thank you. Stephen, I don't know if you want to take this one.
Well, it's difficult really because there's not many places to get full IHT relief now. Given the fact that all business relief is subject to only 50% relief, albeit on some investments at the moment, as we understand, there's a £1 million threshold. So you could move into sort of more private company, much higher risk private company type schemes, or for example, but they can't be held in ISAs, so you could only do that through a non-ISA type account. So there aren't many options left, unfortunately, and that's what the government, I think, are trying to achieve. That they're trying to stop people avoiding IHT and mainly being able to gain 100% relief. So options are limited, particularly if you hold an ISA.
Thank you. Anything else either of you want to add?
No, I think we've covered quite a lot of ground here.
Yeah, we have.
Answered quite a lot of questions. Thank you, everybody who has, posed a question. There are some good ones in there, and I think it's probably watch this space. I don't know what you think, Stephen.
Yeah, I think so. I think there's going to be. I think as I said, it'd be interesting to see the detail, particularly surrounding SIPPs, because I think that's a complex area, and also surrounding other IHT products offered by other firms that are specifically designed just to avoid inheritance tax. So it'll be interesting to see what they do with those as well. So.
Well, thank you very much to both of you for all your insight and careful consideration. It's much appreciated, and thanks, as you've already said, Chris, to all the questions we've received. We received loads of them, and we've tried to go through as many of them as we possibly could. So thank you, Stephen, and thank you, Chris.
Thanks very much.
As mentioned at the beginning of the podcast, to coincide with the budget, the Office of Budget Responsibility released the Economic Fiscal Outlook. Within it, there was a paragraph that was addressing the question of whether business relief and agricultural property relief would still, in effect, have a tax benefit after the changes announced in the budget had taken place. The paragraph states, and I quote, "Where assets qualify for APR or BPR, even if an estate is above the new shared cap, it is likely that the effective IHT tax rate, 20%, is below that for CGT. Therefore, there would still be a tax benefit from holding assets to death. In addition, for all assets, inheritors may take advantage of CGT rebasing on death to minimize their personal tax liability." I hope that gives you an insight into how the Office of Budget Responsibility views it in terms of the changes that are taking place to business relief and agricultural property relief. And they still view it that holding these assets to death would still be a tax benefit. Thanks for listening to this episode of the Professional Investor Podcast. Don't forget to like and subscribe to the series if you haven't done so already, and share this podcast with someone that you might feel it could be of interest to. Thanks for listening.